What are you most squarely focused on at the moment as you try and get a grip on these markets?
Sure. I think that investors are really concerned right now about the stimulus package that's going on in Washington. We continue to see the ping pong back and forth between the White House, Senate Republicans, and the Democrat-controlled House. And I think what's at stake is both the size of the stimulus, but also what the stimulus money goes towards. But what's really happening here is that each side is really pandering to their base ahead of the elections. And so the stimulus has really become more about politics than instead of economics. Now, that being said, I still think that there will be a stimulus package between now and the end of the year, which is what the market is partially discounting.
Okay, so you're expecting stimulus at some point before the end of the year. The election, of course, firmly on the horizon as well. And, of course, the stimulus debate ties into that to some extent. There was a sense amongst investors that you might get a blue wave. It seems like they're paring back those expectations now. What do you think is the market response if you get a Senate that remains in the hands of the Republicans, but a presidency that is with the Democrats?
Right. I think there's definitely a case for that. I think the risk of a hotly contested election has greatly been diminished, and I think that the stock market's recent upward trend reflects a very highly likely win for the Biden and also likely Democrat sweep. However, what's not priced in the market right now is that the Democrat sweep could cause investors to rethink the changes of the investment environment, such as higher corporate taxes and more regulation and government insight to certain industries.
And David, we just had the IMF also just talk a little bit more about China and really just kind of giving it a bit of an endorsement, saying that it's going to be the only economy that is going to see output levels higher this year than 2019. And I want to take a listen to the chief economist, Geeta Gopinath, about that point. Take a listen first.
China is the country where this year and next is cumulatively going to be 10% higher than the pre-COVID level, while pretty much everywhere else in the world, they're going to be below their pre-COVID level. So you do see a very stark difference over here. I mean, China also has a lot of underlying growth coming into this crisis. They were slowing down, but still at growth rates of over 5%, between 5 and 6%. So going forward, they will continue to accumulate higher levels of income. But that said, by 2025, we still have them about 1% below their pre-COVID projected path in 2025.
So based on just the growth prospects, do you think China is still a good case to kind of keep a bias in your strategy? How are you seeing it?
Sure. We continue to remain positive on both China's economic rebound from the pandemic, as well as a positive bias on Chinese equities. I think that there are a few things going on here. If we look at the most recent September trade data, which came in much stronger than expected, both on the export and the import side, I think that this suggests two things here. That on the export side, that the global demand continues to be a key driver behind the resilience from COVID-related shipments. But more importantly, Chinese imports really rebounded from negative 2.1% to positive 13.2% last month on stronger both domestic demand and also on greater purchases from American goods. The case in point is the most recent Golden Week holiday, which saw a large number of Chinese households hit the road, and we saw increased spending at retail shops and restaurants. Now, this is important because half of China's GDP is made up of domestic consumption, and so far this year consumption has been negative. Now, that changed recently as the retail monthly numbers in August finally became positive. And I think that this will indicate that one of the most important cylinders for the Chinese growth engine is finally starting to fire up. And this will give the Chinese economic engine the boost it needs. And I think that the Chinese growth cycle should last for another 2 to 3 quarters.
Yeah, and we're counting down, of course, to President Xi's speech in Shenzhen. We're likely to hear a little bit more about this theme of dual circulation. Does it actually help boost the relative attractiveness of Chinese tech stocks compared to the U.S.? Because in the eyes of Beijing, these are national champions, and whereas in the U.S., you have, if we see a Biden blue wave, that we could actually see these tech companies get split and more regulatory risk.
Right. We continue to be actually positive on tech stocks, both in China and in the U.S. I think that, it's possible to see some near-term volatility because some of the issues on COVID and potential re-lockdowns that could actually benefit tech stocks. That being said, we continue to be positive on China because what we're seeing in Shenzhen and the policy measures that could be announced there is that it's an important signal that China's reform and opening process continues to accelerate. And so this will potentially remove some of the bottlenecks that have really been hindering China's reforms are now being removed.